Hello there, this is Tejas from Trendline, and in this video we'll analyze the initial public offering of a logistics company, Delhivery. Let's begin with an overview and the key takeaways. We'll start off with the details of the IPO and how the company will use the proceeds. We'll then take a look at the overview of Delhivery and analyze how its investments are affecting the financials of the company. I will also touch upon why the employee costs are increasing at a high rate and why the company's losses widened by 3 times in the first 9 months of FY22. We'll end the video with a valuation analysis using a metric called price to sales ratio. This will help us gauge if the IPO is fairly priced or not. Delhivery is the largest integrated logistics company in India in terms of revenue. It is also one of the youngest, founded in 2011 and growing at a blistering pace over the last 10 years. The company uses its self-developed logistics tech stack and data intelligence capabilities to differentiate itself from other logistics companies. And regarding the IPO details, Delhivery is looking to raise 5,235 crore by selling its shares at a price band of 462 to 487 per share. Retail investors can apply for a minimum of 1 lot of 30 shares up to a maximum of 13 lots. That makes the minimum investment of 14,610 and a maximum of 1,89,930 rupees. The IPO will be open to apply from May 11th to 13th. Applicants will be notified if the shares are allotted on May 19th. Finally, the stock will list on the exchanges on 24th May. Now, what does the company intend to do with the proceeds and who is actually selling their stakes? So out of 5,235 crore, 75% of that, that is the 4,000 crore is a fresh issue and the remaining 1,235 crore is an offer for sale. Delhivery plans to use 2,000 crore for expanding its businesses, developing new business lines, and also upgrading its logistics operating systems. And 1,000 crore rupees is earmarked just for acquisitions. And regarding who is selling, let's take a look at the pre-offer shareholding pattern of the company first. So SVF Dobel, which is a SoftBank Vision Fund, holds about 22% of the equity share capital, while Nexus Ventures and CS Swift Investments hold 8.9% and 7.2% each. Major investors like CS Swift Investments, SoftBank Vision, and Times Internet will be reducing their stakes in the company. And there are a few individuals and founders that are selling their stake as well through this IPO. Now let's dive into company analysis part of the video. So as of December 31st, 2021, Delhivery's pin code reach number is at 17,488, which covers about 90.6% of the total pin codes in India. In FY19, the number was at 13,485. Since then, the company has aggressively expanded its network and plans to expand more in the coming years. Delhivery gets about 64% of its revenue from the express parcel and about 19% from the part truckload services. Express delivery refers to delivery of parcels weighing less than 40 kg. These are typically e-commerce orders or business documents with a turnaround time of less than 3 to 4 days. This segment was estimated to be around US $2.3 billion in fiscal 2020 and is expected to reach 12 billion by FY26 at a CAGR of 28 to 32%. And Delhivery has 22% of the e-commerce parcel share. The performance of the company will obviously be highly correlated to how e-commerce industry in India will fare in the next few years. The e-commerce industry in India grew 31% from fiscal 18 to fiscal 20 and is estimated to grow further by 33% from 2020 to 2026. Many companies like Amazon and Flipkart have their own in-house captive logistics arms to deliver their parcels. In FY21, 59% of the total e-commerce shipments in India were handled by captive logistic arms of various companies. Third-party logistics companies such as Delhivery and Blue Dart make up of the remaining 41%. This is expected to go up to 46% by FY26. With regard to the tech aspect, the company is investing quite a bit in this logistics operating system and also cloud infrastructure, data intelligence system as well. And in 9M FY22, Delhivery invested about 242 crore rupees in upgrading its tech stack, an increase of 88% from the same period previous year. One major factor that constitutes the expenses here are the employee costs. Like most tech companies, Delivery is also facing big problem with retaining and hiring skilled IT professionals. And because of this, the attrition rate for its IT employees in 9M FY22 stood at 40.3%, which is a very high number. So this means employee costs will further increase, thereby reducing the return on investment. Though the investment in tech will help the company in the long term, Delivery may not reap the benefits in the short term. And given the fact that it is losing money year after year, these big investments can push the company's expected profitability timeline further. Now, let's take a look at Delivery's financial performance over the years. If you look at the available data, the company is yet to make a profit. Though it became the biggest logistics firm in terms of revenue, its losses widened by around 3 times in 9M FY22 compared to the same period previous year. One of the reasons for this is employee costs, which increased 90% to rupees 972.6 crore, mainly due to high attrition rates and ESOP costs. Another interesting factor in the income statement is that the company took a fair value loss of about 300 crore rupees on financial liabilities at fair value in 9M FY22. This is due to conversion of Series G compulsorily convertible preference shares or CCPS into equity shares of the company. Series G shares were issued in September 21 to key management personnel and other individuals, and this is a non-cash expense. So if we take 9M FY22 operating cash flows, which is in the negative, Delivery is burning about rupees 56 crore cash per month. With such an intensity of cash requirements, IPO proceeds will also be used to sustain the business operations going forward. Though Delivery is a loss-making company, it is operating in an industry that is growing at a very fast rate. The Indian logistics sector is a fast-growing sector with a direct spend of about $216 billion in 2020, and it is expected to grow to $365 billion by fiscal 26 at a CAGR of 9%. And organized players just make up of 3.5% of the logistics market. But the number is expected to go up as organized players are expected to grow at a CAGR of 35% between FY20 and FY26, taking their share in the logistics market up to 15%. This shift is expected to be driven by the ability of organized players to offer integrated services, network and scale-driven efficiencies, and also larger investments in technology and engineering. If you look at India's organized listed logistics players, major competitors for Delivery are Blue Dart, Mahindra Logistics, TCI Express, and VRL. Now let's have a look at how the company is valued for its initial public offering. A company could be performing exceptionally well, but if it is overpriced, it won't really offer much value to the investors. This is why company valuations is a critical part of the IPO. To explain the basis of offer price, the company cites high growth in its revenues and its proprietary logistics operating system as its competitive advantage. Though the company has in fact increased its revenue over the years at a very high rate, it is yet to show profits in its earnings reports. To evaluate if if the IPO is priced fairly, let's compare a metric called price to sales ratio of Delivery to its peers. One major competitor of the company is Blue Dart. DHL acquired a 81% stake in Blue Dart and currently owns about 75% of the company. Other listed competitors include TCI Express, Mahindra Logistics, and VRL. As seen in the chart, at the upper band of the price band, the company will be valued at a implied market cap of about 35,285 crore. This takes the price to sales ratio at 5.4, which is pretty high compared to its peers, especially its closest competitor, Blue Dart, at 3.6. Even in terms of international peers, the price to sales ratio seems pretty high, especially in the current volatile market conditions. So in this video, we analyze the IPO of Delivery starting from its details to its valuation. To cap it off, the company is asking for a high valuation as its revenue growth and the industry it is operating in are growing at a very fast rate. However, investor will also have to look at the profitability timeline and the high valuation ask before applying for this particular IPO. So you can find more information on IPOs in the IPO dashboard section of trendlyne.com. This is Tejas signing off.